we are going to go through supplementary benefits or living benefits, as they are commonly called. You can find more information about them in section 5.2 of your study notes. So if you're looking for more details, check it out there. We are first going to go through three things that will help you remember what supplementary benefits are all about. And those three things are: the benefit is received while the insured is alive, it can affect the death benefit paid to the beneficiary, and it does increase the cost of the insurance policy. So the first thing that we're going to start off with, or the first big one that we're going to start off with, is the accelerated death benefit. And the accelerated death benefit is that a portion of that death benefit is received before death. So the insured is receiving the amount that would have been paid to the beneficiary. That amount is deducted from the death benefit, so the beneficiary will receive less money when the insured dies. And there are two different situations in which the accelerated death benefit can be used. The terminal illness benefit, and this is when the insured is expected to die of an illness in under 5 years. Now, that time period might vary, but it's usually around 5 years that they have a decreased life expectancy. And it can be built into the policy, or it can be an extra benefit that the insured has actually asked for, the policyholder has actually asked for. There's usually a maximum amount of the death benefit that the insured can receive as part of this benefit, and that is always defined in the policy. So this money is paid to the insured as a loan, but it is received tax-free, so it's not included in their income. And what's really important to remember is if your clients do have an irrevocable beneficiary on their policy, that person does need to give permission in order for this benefit to be activated. The second accelerated death benefit is the dread disease or critical illness benefit. In this situation, the insured is not terminally ill, so they are expected to survive or hope that they will survive. But they have one of the illnesses that's listed in the contract under the critical illness benefit. And typically with all insurance companies, it covers the big four, so heart attack, stroke, coronary bypass, and a serious type of cancer. However, there usually are some in addition to those big four, possibly up to 24, even more, depending on their contract, and they do clearly list what is covered in that contract. And again, this is received tax-free, not included in the insured's income. The other three supplementary benefits are accidental dismemberment, waiver of premium for total disability, and parent waiver benefit. And we're going to start off with the accidental dismemberment benefit. So that is a lump sum that is paid if the insured loses a body part or a function, so they're unable to use that particular body part. And the amount that is paid does vary based on what the loss is, or the significance of the loss, the impact that it will have on the quality of life for the insured. And so, for example, they'll have a chart in the policy, but it could be something like you've lost both of your limbs, two of your limbs, and in that situation you might get 100%. However, if you've lost function in your hand, you probably wouldn't get 100% of that death benefit in that situation. So it does vary, and it's important to check out the contract. As the same thing with all of these contracts, the details of what is really important and when these supplementary benefits can be activated are always in the contract. The waiver of premium for total disability benefit, the premiums are waived for everything in this case. So whether it's the actual cost of insurance or whether it's additional riders or supplementary benefits on the policy, everything is covered. And the insurance coverage continues on until the total disability ends, if it does end. Now, the definition for total disability is always defined in the contract, so it's very clear when this will come into place. And there's usually a waiting period of 30 days. Some insurance companies will pay the premiums after the 30 days. They'll go back and pay those premiums that were paid by the insured during that waiting period. Some will not. It just depends on the insurance company. And these premiums do continue to be waived on renewal if it's a term policy, and if it's converted to another policy as well, this benefit does still continue to be in place. The last one is the parent or payer waiver benefit. Now, the reason it's not just parent is there could be some sort of business situation that this waiver has been put on the policy for. And the key point of this is that the insured is not the payer. Somebody else is paying for the policy. And the health underwriting for this benefit to come into place is based on the payer's health, not the insured, like the other options or the other benefits that we've talked about so far. Now, with the parent waiver benefit, usually there is some sort of set age that the insured might need to start paying for the policy, like 21. However, it is possible there's also no set age, so it really depends on the policy. And that's it for supplementary benefits. If you are looking for more information, 5.2 in your textbook or in your study notes.